Hi traders, and welcome back to this week's chart scan. My name is Marco Meyer from Trading Educators. This week we'll have a look at a day trading strategy idea one of you guys sent in. It's for the E-mini stock indices based on some simple pattern plus a filter, and I'm going to give you some thoughts about such day trading strategies in general. So here's Milton's trading idea. He suggested to trade it in the E-minis, like the E-mini Nasdaq, the Russell, and the E-mini Dow, on time frames as low as 3 and 5 minutes. And the entry signal was that if the close of a price bar is in the top 25% of the bar, so if it closes in the upper 25%, and that close is above the 21 period Donchian midline, then buy 2 ticks higher at the close of the previous price bar. So on the next bar, buy 2 ticks above the close of the previous bar, and to simply exit on a close below the 21 period Donchian channel. So if the market trades below it again, the idea is if the trend stops, then get out, and do the opposite for short trades. So sell if the close is in the lower range of the bar and if it's below the 21 period Donchian midline. From my experience, I knew right away that there's a couple of things that probably don't make much sense here. First of all, that filter to buy 2 ticks higher than the close of the previous price bar. I've tried filters like this before and I just know that they don't add anything. All you get is that on a lot of trades you're gonna enter 2 ticks worse, because most of the time you're gonna get triggered anyway, and on average it's going to be better to just get in at the market or try getting in with a limit order at a little better price maybe. So this is my version of it. The second thing I changed was the time frame. I played around with it a little bit and it didn't do too well on 3 minutes or 5 minutes, and so I switched over to 10 minutes and made a trading window between 11:15 and 16 New York time using the regular trading hours only. We need some time to initialize those Donchian midline, and that's what this does. It also prevents us to get stopped in too early on the day, where in the stock indices we quite often get some wild action in both directions. I left the other rules as they are. Another thing I added is if we're still in the trade at the end of the day, let's exit there, because we don't want to deal with a gap. So let's have a look. First thing I did here is, for everyone to understand the idea, I plugged in these Donchian channel lines. Again, what this does is it gives you the highest high and the lowest low of the last whatever price bars. In this case we're using 21. And that midline simply is the average between the highest high and the lowest low. So you get something like a moving average, but instead of being based on the close price, it's based on the highest high and the lowest low. The second thing that I did was to mark the bars that are interesting for us. So the idea was to trade only if we have a strong move in a single price bar. So in this one, for example, we closed in the upper 25% of the bar, and so it's a valid bar. For short trades, you want to see the opposite. We don't want to see them close in the lower 25% of the price bar for short trades. So the red ones are the potential shorts, blue ones are the bars for potential long trades. Again, I'm using the regular trading hours only, so I got rid of the overnight session because I know that it doesn't make sense to trade a strategy like that before the actual open of the market. Before that time, usually in the US stock indices, if you want to trade, you want to do the opposite of a breakout kind of strategy. Next, let's have a look at the actual strategy. It was quite simple to do that. So for long trades, let's have a look. First we have a look if the time is in the time frame we want it to be in, so not before 11:15, not after 16. We want the close to be above the Donchian average, and we want the close to be in the upper 25%. This is what this formula does. And if that's the case, we're just gonna get in at the market. Same thing for short entries, just the other way around. Check the time, check if the close is below the Donchian average, and see if the close is in the lower 25%. our stop loss. It's not a stop loss order, it's triggered on the close of each price bar. So we say, okay, if the close is higher than the downtrend average for short trades, we want to exit on the next price bar at the open, and the other way around for long trades. And the last one is simply a time stop that's going to get us out at the market close if we're still in the trade. So one example of that was yesterday's trading day. We waited till the time was past 11:15 and then looked for potential entry signals, and we got one here. The close was higher than the average, the downtrend average, and the close of this price bar was in the higher 25%. And we got in right here. And as you can see, this one worked out very nicely, meaning the price stayed above that 21 period average throughout the trading day, and we could actually at the close of the trading day with a really nice profit. Now on other days, like the day before this, things haven't been as good. So here, for example, you would enter short, get stopped out here, enter short again, get stopped out again, enter short again, get stopped out again, short again, stopped out, short again, and then made a few ticks profit until the close. So I guess the idea is clear to everyone now. And it's always important to do what we're going to do now, which is we're going to look at some statistics and do a backtest. All right, going to start with a mini Dow, and I'm going to start in 2011 with this. So we have about 5 years of data. I'm going to start without adding any commissions or slippage. So here we go. We got about $28,000 profit factor of 113, which isn't that great. The main issue you can see here right away is the average trade being just $7.80. That's simply not enough for any strategy to be really profitable, because as I said in the beginning, we didn't include any trading costs yet. So no commissions, no slippage. And we have a strategy here where we're always going to enter with market orders or get stopped out by a stop market order, which means that at least in the E-mini Dow, in the Russell, and also in the Nasdaq to some degree, we're going to have slippage quite regularly, even if it's just a tick here and a tick there. Less so in the E-mini S&P, where we have a lot more liquidity and still going to get some slippage, but not as regularly as in the Russell or in the Dow, for example. Now, if you look at the price chart, it actually doesn't look that bad, right? It did pretty well in 2011, good in 2013, not so well around 2013, and then it really sort of took off. But again, the issue here really is the average trade, and we know that that's going to be a problem. So it looks good like that, but what happens if we actually put in some commissions, and let's say we pay $5 round turn, got a low cost broker, and let's add a tick slippage. So in the Dow, that's $5. And what you can see now is the whole thing really turned around. So what looked like a positive strategy before looks much worse now, simply because we added the trading costs. And that's a pretty common problem. Even during the times where it took off before, between 2014 and 2016, it's still going up, but much less tradable in my opinion, and more going sideways than up really. Okay, so what about the other markets? And it's pretty much the same actually if you look at the Russell, for example. Leave the commissions out first. We get a profit factor of 114, $63,000, and an average trade of $18, which is better than in the Dow. And our curve actually looks okay. I mean, we had nothing going on here really for years, but during the last couple of years the strategy worked out okay, I would say. At least during the last year it really took off. But again, if we add some slippage and commissions here, let's say $5 commissions, 1 tick slippage per round turn, which isn't that unrealistic actually, again things look much worse. So the average trade is down now to $3 and the profit factor to 1. And again, this is what the chart looks like. So yeah, during the last couple of months, it still was a good strategy. But at least for me, this by far wouldn't be enough to decide to actually trade this in the markets. The last market I want to have a look is the E-mini S&P. First without commissions. Looks pretty good, doesn't it? So especially during the last 2 years, the strategy performed really nicely here. Now the E-mini S&P is a very liquid market, so we're gonna get less slippage here than in the Dow for sure most of the time. Again, let's say we pay $5 commissions and let's add half tick slippage, so that's $6.25 to that. Gonna end at $11.25 per round turn, and have a look at this. Same problem, average trade goes down to about $3, profit factor from 120 to 104. Now, from my experience trading these markets, the values we used haven't been too pessimistic actually. So if you say, okay, going in and out of a trade both times with a market or stop order, that's actually not too pessimistic, I think. Which brings me to the next point, and that's something a lot of traders forget all of the time. So they backtest the strategy, they don't think about trading commissions at all, they don't think about slippage, and then they have a really great strategy for a market like, let's say, the coffee future, for example, and are wondering what the hell is going wrong when they actually go live with the strategy, because the performance is going to be much worse than in their backtests. And the reason for that really is that they didn't think about trading costs at all. Which leads me to the next point. Because of these trading costs, most day trading systems simply don't work. I can come up with a ton of systems that look really, really great in a backtest, but as soon as you add trading costs, it's gonna look the opposite, right? It's gonna look like this. Simply because the average trade you get out of these isn't big enough. All day trading strategies I found that are doing well are strategies where you have 1, maybe 2 entries per day, 1 to 2 trades, and that's it. So either you trade around a specific time of the day on a low time frame, for example, where you then do your trade and that's it, or you try to catch the move of the day, you get in at a certain price, and then you just stay in till either you get stopped out or you reach the close of the day and exit there, or exit on the next day's open. If you try to trade in these short swings here, I can almost guarantee you that trading costs will eat you up. Alright, so thanks for watching. Hope to see you again next time. If you're not a subscriber of ChartScan yet, you can become one easily by going to tradingeducators.com. It's for free and you're gonna get it every week. So each time we get new content like this video or articles we publish, you're gonna have an information in your mailbox that they are out. If you have any questions, so you can send me an email at marco@tradingeducators.com.